and welcome. My name is Vicky Washay, and this is the second of a series of 12 podcasts that I'm going to be doing about property. It will have threads of business in here, it will have lots of finance in here, and of course, it'll have some specific property tips and strategies and thoughts. And this week, what I'm trying to get you to believe, to recognize, is that of all the different investment classes you can get, property is like the tortoise in the hare and the tortoise race. The hare will race off, everybody's investing in crypto, in gold, in doing stocks and shares, and the tortoise, your property portfolio, is just going to plod along. And it's going to plod along, it's going to make sense of the fees, it's going to make sense of the returns, and at the very end, if what denotes that you are a winner is that you haven't had to spend a lot of your time, you've had a second income, you've got assets that have grown in value, and you've got cash in your bank account, then I bet the tortoise with the house on the back is going to be the winner. So enjoy. So the thing about property is whether you do it fast, whether you do it slow, it's actually the long term that counts. Property is better when you plan to do it for 5, 10, 15, 20 years. And that's because there are initial startup costs. There are always initial startup costs in any business. So the most direct startup costs are things like your solicitor fees, your broker fees, your survey fees, all of that sort of stuff that starts with each individual property. And you have that on every single property. But also, if you're going to be investing into a limited company, you're going to have account fees that are there right at the beginning. And so if I give you this as an example, if we took £10,000 and we spent it in a year, it's going to cost us £10,000. But if we spent £10,000 today and what we spent it on was going to last us for the next 10 years, it's almost as if we spread that cost out over the 10 years. And it would be as if we spent only £1,000 a year. And then in 10 years' time, we spend 10 grand again for the next 10-year period. And that's a banking term called amortisation, and that's where they spread out the payments over a period and look at paying things down. You also do this with depreciating costs in accounts and stuff like that. So yes, it's still 10 grand, but it's not that you're paying for it every year. If you only do this for the short term, if you only decide that you're going to get one property, you're going to take it out on a 3-year mortgage, and so you're going to pay your 10 grand, and then in 3 years' time, you're going to throw all of that away. Those overheads have to be worth it. They have to be counted when we're looking at the profit to make sure that this is still a good idea. And so that's one of the things that makes development more complicated, because there are a lot of upfront costs, and whatever comes out at the other end, you've got to make sure that you've paid for all of these costs. You've paid for all the buying, you've paid for all the redevelopment as well, and then you've paid for all the selling within that period, and it was a good use of your time. So a lot of people these days, and it changes, when I first started investing, we were looking at 3-year mortgages as being quite adventurous. Now, most people take out 5-year mortgages. And there's a couple of reasons for this. One, you're guaranteeing yourself the rate, and therefore you are guaranteeing your projected income. But also you're spreading that cost, you already know that, out over the 5-year period. And of course, there's always lender fees. And so that's one of the things that you need to look at. And remember, I'm not a financial advisor or a tax advisor, but whenever, and let's be honest, your broker should do this for you, but whenever they make you an offer and they say, for example, you could have a 3-year or a 5-year, you could have this deal with that lender or this deal with that lender, don't just look at the interest rate, look at the fees. Because what you can often find, and we just had an example come through from one of our brokers, you can get nice low fees, but you're looking at but you're looking at 7 grand in fees. But if you work your way slightly up, you can get a decent rate and only be paying 199 on a fee. And when you work all that out, when you take those fees and you spread them over the number of years, actually it means that the slightly higher interest rate with the slightly lower fee works out to be more cost effective, more profitable than if you took a lower rate with a higher fee. And I know why people will do this. They'll do it because what they're thinking about doing is maximizing their cash flow. So apart from explaining the costs and how you spread the costs, why is property the tortoise of investing? Let's have a look at that. So what happens over the long term when you invest in property, or even if you don't invest in property, you just know house prices go up and down. If we just look at the last 20 years since I first started investing, house prices have, I would say, in the area I've been in, easily gone up 50%, if not more. There used to be a saying that house prices doubled every 7 to 10 years. I can't say I've found that true in the north, or maybe it's not true since we had the crash in 2008. Maybe the crash readjusted the prices so much that it's taken a bit longer. But the fact is, we live on an island. We have stuff called greenbelt. We have stuff called city centres. There is only so much land on which you can build. And we know the government's already making plans about allowing us to go up into the roofs of our houses. Not completely sure how that's going to save or solve the problem, because all that'll do is put another bedroom in my loft. How is that going to put anybody else off the housing list unless I'm going to allow them to walk through my house? I don't know. It's all going to get very complicated, but whatever. So house prices go up and down. And if you go in and out quickly, you might not benefit from the long-term gains. Equally, you could go in when the prices are high and end up selling when the prices are low. So think about 2007 to 2010 as one example. So in 2007, the prices were at a peak. It was just the start of buy-to-let going crazy, I suppose. High street mortgages, not high street mortgages, as in literally on the high street, but we call them high street buy-to-let lenders. It was becoming more available to get buy-to-let mortgages in 2007. And so the market was really picking up. And then all of a sudden it all went wrong in America. It rippled around the world. It would have gone wrong for us eventually. And then the crash happened. And we know that it was a global crash and the property prices fell. If you'd taken out a 3-year mortgage in 2007, you would have then come out of that mortgage in 2010. The house prices would have been low. You may or may not have been able to remortgage because you could have been in a bit of an equity problem. And you might have decided to sell and get out of it. You might have decided, well, this is ridiculous. I bought it for 100,000 and now it's only worth 60 or something. But those are paper numbers. That's what you have to understand about this. That whatever the value of your house is, I'm going to be harsh here and say it doesn't matter until the day you decide you want to sell it and somebody accepts your asking price. That's the point. When you complete, that your house actually has a value. Any point up until then, it's just talk and it's not reality. So if you're investing in property because what you want to do is get cash flow from the rent coming in minus the mortgage and the letting agent fee and the running costs, and you want to make that profit, and that profit is for reasons we spoke about last week, then the value of the house doesn't matter. The very first property I bought on my own, I paid 70, something like 75, 78,500. I made up such a silly number. I can't actually remember what the number was, but somewhere around 75, 78,000 pounds. At one point, there was a house that sold on the street for just about 49-ish thousand pounds. Did that mean that my house had then become 49,000 pounds? No. It meant that my house was still rented. It meant that my house was still making me 300 quid a month because I had a tenant in there. I had a nice long, low mortgage, and I was making the difference between the rent coming in minus the mortgage and the letting agent going out. I was still making a profit on that house. I didn't sell it. I didn't have all of those overhead costs that we spoke about just a minute ago. It didn't matter to me what the value was. Sometimes if you're going to, and here's a caveat, if you're going to change lenders, so if, for example, you're with Birmingham Midshires and you're going to switch to NatWest, then the new lender will want to do a survey, and that can cause you a problem. But if you just go on to the next product with the same lender, most of the time they don't bother. They just stay with you and they let you just roll on to the next product. Now, I'm not saying about staying on the standard variable, unless, of course, that's in your favor. There was a point where if you had bought in 2007, the interest rates would have been about 4 or 5 like they are now. And then the rates started to fall, probably 2012, 2014, somewhere around there, the rates started to fall. What you could have done is got a mortgage that was, say, 5%, and the standard variable, which is what you fall onto when you fall out of that product, the normalized rate that you would go through, was made up of 2 figures, and it's made up of the standard variable rate and base rate. So base is whatever the Bank of England is charging, and then there's this little add-on, and if you read your mortgages carefully, you'll see these numbers. It applies to whether it's buy to let or whether it's your residential. And this standard variable rate, particularly for some people, and we were lucky we had these Mortgage Express mortgages in the day, that the standard variable, I think it was something like 0.25%. So base plus a quarter or base plus 0.1, something like that. They were so tiny, it was ridiculous. Base eventually fell down to, the Bank of England base rate fell down to 0.5 and then 0.25%. And goodness, we had a mortgage rate where we'd gone on the mortgage at, I think, 4.8, something like that, and we'd come out to the mortgage and the standard variable rate wasn't even a full 0.5%. So we just stayed there. We didn't bother to remortgage at all. When the rates changed, and of course it was more complicated because Mortgage Express shut down and then they sold their mortgages over to somebody else, but that's a whole nother story. Then we did end up changing our rate. But that ebb and flow of the property price made no difference to us. Now let me bring you forward to COVID again. So in 2009, I was buying for my clients, and we were buying properties probably in the high 90s. Then obviously everything shut down because of the pandemic. When we came out the other end, the market went a bit mad. Property prices went up. We were looking at some of those properties being worth 120, 130,000 pounds. They had gone up a ridiculous amount of money. Now, it didn't do that all over the UK. There was this sort of shifting where everybody suddenly decided that if they lived in a flat, they didn't want to live in a flat anymore. And so everybody in flats who could afford to moved out into houses. That depressed house flat prices quite a bit, which I don't feel like they've really recovered yet, even though we're some 4 or 5 years later. And everybody was moving into houses, all the residential people, and of course the buy-to-let people are still there. And that sort of put some demand in the classic 3-bed house market. And so prices rose. There was a little flurry. Everybody jumped in. Those that were clever and sold and made a fortune, a nice little bonus on the top. And those that held have now got properties with more equity in place. So this is something that you can't predict. Well, nobody could predict COVID, although there will be a few American scientists that say that they did predict it. Nobody could predict the depth of the global crash in 2008. Again, although there'll be a couple of American financial people who said that they were warning about it. But the average, us, ordinary people, unless you're tapped into some very strange groups, you won't be aware of all that's coming down the line. And so it's only by being in something for the long term, where you can ride those waves as they come in, that you're focused on the cash flow. That's the key thing. Yes, it's about the highest price, because in the end, that's where the mortgage is, and that's where the debt and the mortgage cost comes. But it's very much about understanding the rents as well, and what is the rental demand in your area. So number one is that property is for the long term. Number two is, if there is this ebb and flow, how do you know when it's the right time to join the race? And it's not really a race, but because I've used the analogy of the tortoise, we're talking races. So everybody is running their own personal race. It's like doing a marathon. And yes, there are the elite runners, but we're not competing with the elite runners. We're just the ordinary people. We've got our own watches. We press go when we start. And then what we're looking to do is to get our own personal best time. That's what you're doing with property. You are running your own race. And so if you have the cash to invest and the deals that you are looking at will give you a net return on investment. So not yields, forget yields, return on investment. Sometimes people call this cash on cash. It's how much money you're going to make by investing in this property. Is that going to be more than if you just put it into a steady buy to let? If the answer is yes, then this could be the investment for you. And what you've got to bear in mind, as I've said before, is not only is it the revenue that you're going to make interest on, but you've got this potential for long-term capital gain. If that makes sense, then that's what you're looking at, because you're never going to be able to predict exactly where we are in that curve. So if you can imagine a roller coaster, you go up the curve, then you're at the peak, then you come down the curve, then you're at the bottom. With property, this curve is going up and down. The down it comes to is never as low as the starting point. Then you go back up. The new high is higher than the last high. Then you come down. The new low is still higher than the last high. Oh, sorry, the last low. So I don't even know if you got that, but that up and down, it's a constant wave upwards. It's not a horizontal wave. It's not a steady wave. It's a climbing rate. So understanding that the prices are always going to go up. It's about looking at the moment. What do you have in the way of resources? What do you want to get out of property? And is this deal a deal that could help you do that? So it is over a long term, number one. The ebb and flow just means that you have to look at your own race. Does this work for you? And then I've spoken about spreading the upfront costs, spreading those out over a deal. This is about how long you hold the property how long you hold the property for. And then over time, remember, not only are you going to spread the cost of the costs to set the property business up, but you are then going to benefit from a gradual increase in the rents that you receive. Now, if you're working your business well and you're using a letting agent, every year on the anniversary of the tenancy, what you should be looking to do is to put the rates up, the rent up. So how much they're getting at the moment, let's say that they're getting 700 quid. You can put that up by 10%. As long as the rents in the area are in the high 70s or high 700s, high or low 800s. And I can't imagine this happening, but you've got a tenant on a rent of 700 at the moment, and then all of a sudden the rents in the area fall to 600, it might be difficult to put the rent up. I think the only time that happened to me was when we were looking at HMOs over in the east of the country, and all of a sudden some investor came in and they literally bought 100 properties. They put all the house prices up, nice, but they also caused all the rents to drop because they flooded the properties or the property market with supply. There were so many HMO rooms suddenly available that people didn't have to pay the price. So instead of paying 120 per room, they were looking at now only paying 90 per room. So there's always this balance going on. But in normal 3-bed houses, at the moment, there is a shortage of housing. We know that. And so rents are steadily climbing. In an area where I was lucky when I first started investing in this area, I would say I probably came here about 10 years ago to this new area, that the rents would have been about 600, and 600 was 100 more than I was getting in my main area in Liverpool. And I was quite delighted to suddenly get £100 more. The house prices were maybe another 20,000, but it was worth it. Those rents, we're now talking about the high 800s to the mid 900s. I'm looking at a deal at the moment that I've got for myself where I'm going to get 995 on the rent on a house that is just 20 grand more than I would have paid for it in the past. That is a phenomenal increase in rent. And in some ways, I do feel very sorry for the tenants, but it's a supply and demand issue. It's a marketing issue. It's not my fault. It would be the same as petrol stations. If one petrol station puts the prices up, you might hang on as a low rate for a little while because you'll get all the customers come to you, but you will gradually put your cost of petrol up. Why wouldn't you? If everybody else in the town has increased the price of petrol, you'll increase yours. If every landlord in the area, because there is so much demand, increases the rents on a 3-bed house, you will as well. Now, what are the negatives of investing in property and this idea that it is a long, slow game? Well, I don't think these are negatives so much as things that you need to consider. That if you're going to hold property for the long term, what you're going to hope is that your tenant stays, but the longer you hold it, I suppose it's a risk, the greater the risk that the tenant will leave. When the tenant leaves after being in the property for a long term, you're going to have refurbishment costs. So you're going to have to redecorate the whole house because wear and tear. And remember, what you want to do is come back out into the market with a fresh, clean property, that doesn't require you doing lots of little maintenance once the tenant moves in. So you do it all up front. But more importantly, that it is desirable, and therefore you're going to get the best new rent from your new tenant as possible. If you just don't redecorate, or you just leave it that you clean the carpets and you leave the kitchen that's now maybe 10 years old in there, and you don't do this work, then you're not going to get the premium rent. Then all your future rent increases is going to come from a lower level. And so there's a point at which you consider what is the cost of a full or partial refurb on your property. And it might be that you just change the cupboard doors. It might be that you change a worktop, that maybe the tenant put a hot pan on, and so that comes out of the tenant deposit. Maybe they spilt wine or damaged the carpet in some way, and that carpet comes out of the tenant's deposit. But there will be some costs that you will bear. Now, you can mitigate tenant damage through your inspections. You can claim from the deposit because you'll have an inventory, and the rest of the costs are to you. But you will have had a tenant, let's say, for 10 years, so you can save a little bit of that money over the 10-year period and have a budget at the end that will allow you to, for example, we've just done one deal at the moment where the tenant who belongs to the existing owner is paying $750. We're going to do a refurb and we're going to come back out in the market at $825. If you take that money and times it by 12, basically we're going to spend the first year's extra profit doing the property up with a coat of paint. We're going to spruce up the kitchen. The bathroom is perfectly fine, and we're going to replace 2 carpets, and we're going to, in a sense, pre-use. But it's all still part of the initial cost. This deal still makes sense. By the time we get to the end of the year, you're going to be a full 50 plus pounds a month more. So that 600 a year is going to be perfectly fine going forward, and you're going to be able to do your increases based on that. Now, what about the boiler? That's a big cost. They usually trip up when they're switched on at the end of the autumn. So you can count the cost of a new boiler. So let's say it's 3,000 to make the maths nice. First of all, this is an expense that will be offset against your profit on your rental income. But a boiler, if treated well, if regularly serviced, and if you buy them so that they have flushes and all of that sort of stuff, could easily last you 15, 20 years. Think about home. You know, when did you last change a boiler at home? We've had the same boiler, touch wood, let's find wood, for a good number of years, and it's going fine because we take care of it. So if you take care of the boiler, and if you take care of the property through your inspections, then these more expensive costs actually can be alleviated because you're paying attention, and you can push them back out into the future, which again, we're thinking about that amortizing. If the cost of a boiler is £3,000 and you pay for a boiler every 3 years, it's costing you £1,000 a year. If you cost it out over 21 years, I'm not going to do the maths, but you know, it's a lot less spread out over 15 to 20 years. And of course, remember that when we do this tenant changeover, as I just said, this is your chance to rebalance the rent out into the current market, so that you're going to go back to, I started at 700, then I went to 770, and I'm only putting it up 10% each year because that's what the market's allowing. And also I want to keep my tenants, so I don't want to make it too high. But you might find that you've still been lagging behind market rent. So if you started at 500 and you added 50 and you added £50 every year, you wouldn't be at the £900 a month that I said to you about, because there's been a huge demand in the area and property prices have gone up more than the 10%. So when a tenant moves out, you've got this opportunity to rebalance your rent. So if you plan that property is going to be a long distance race for you, like most professional investors do think, for example, then the biggest benefit is once you establish your portfolio, you can put all the properties in there that you want. Let's say you want 5, or maybe you want 10. You've gone through that acquisition phase. Then you can start consolidating. And I'm going to talk about this in a week or two. You can start consolidating the portfolio, paying down the mortgages, paying off some mortgages, so that in the end, you have a portfolio where there is no debt and there is all income, and you've got all of the properties properly managed, and then you're having that wealthy life retirement when you want. And remember, you don't have to wait till you're 65. You can have it whenever you like. What will have effectively happened is that your tenants will have bought you the house. The rent that they've been paying you has been paying off your interest-only mortgage, so you still own the debt. But if you save up that gap, that profit that you weren't using, and you start to pay down, then you can see how your tenants are generating the cash flow for you, and then the surplus that you don't use is being used to pay down the bigger debt. Like I say, we'll talk about this more in next week or the week after. So let me just give you a couple of examples before I finish. So one of my clients bought an initial 2 properties with me. I think it was probably 2012. I think I met him at the book launch for Property for the Next Generation. And then what he did was, he was still working. He was quite happy with the 2 properties. He came back to me 2 years later to buy 2 more properties. So now he's got 4 in his portfolio. And we've also talked about him learning to source for himself. What he's been able to do is retire early, retire in his 50s from a job that he hated, I have to say. He has the most incredible holidays now, and he's living his own very wealthy life. He has just 4 properties, 4 HMOs, granted, but 4 properties. And they are giving him the income that he needs, that he and his wife have both given up work. First, he gave up work, and then when she was ready, she gave up work. And they're in their 50s, and now they're off traveling around and having a wonderful time. So understanding what available cash you've got now, and as I said to you last week, what you want to achieve will determine your overall strategy. Hopefully it will determine that you're going to go in for the long run. You're going to be a tortoise. You're not going to rush in and go crazy and then risk everything. And then you're going to be able to create that life that you want. Another one of my clients is a music producer, which obviously during the pandemic really affected his business. He wasn't able to travel around the world doing all the stuff that he did. We already knew one another because he'd originally been a mentee many years before. And so he knew that what he wanted to do was, as soon as the pandemic was over, he wanted to get back into investing. But of course, as soon as the pandemic was over, his business took back off again, and all the backlog of work had to be dealt with. So he came to me and asked me to help him invest his money. So I switched from mentor to sourcing agent. Because he didn't have the time, he was leveraging me as his time resource to help him grow. Now he's busy back, focused on his own business. He's got some 8 or 10 properties in there. He's focused on his passion, which is music, but he knows that property is there as that second stream of income. So should anything happen, he's got that extra income still coming in on a monthly basis that gives him that reassurance that he needs, even though he's got plenty and he's fine. But it's just nice to know there is an account where money is coming into. So I think if you like, the bottom line of this is no matter what the government of the day does, property has been and will always be a good investment. We can go back in history. You know, I keep telling you this. It's never gone out of fashion. It's always in demand. But the key thing is that you need to make a balance between your available cash, how much is worth you leveraging with a loan, and if that makes sense for you. And of course, the return can fluctuate, but if that return makes sense for you and it's better than you can get in a building society, then property will be a good idea. And as long as you're in that limited company, you're going to benefit from not having to pay capital gains, where in private names you will. You're going to be running a business, which means there are certain expenses that you can offset. We've spoken about that before. So what I really wanted to, just before we get too far into this series of 12, is just reinforce the idea that property, well, maybe it is a bit sexy, but it's not quick. It doesn't have to be quick. It doesn't have to be a race. Although I'm using the analogy of a race anyway. You can be that tortoise. You can work out what's right for you, create your strategy, as I explained in the last episode of the podcast. Go back and check it out. And then if you need help, I can help you and we can pick out the right technique for you. And then you can either go off and do it yourself or I can help you with it. So really get clear on what it is that you want property to do for you and recognize that you are getting into something that's not like trading. You're not having to look at it every day, every hour. You're not watching those lines going up and down on a minute by minute basis. You're taking that long view. You're going to invest in something that has got overheads and you want to see them paid out over the future. So I hope that has made a lot of sense for you. And I hope that I've put some whoosh into your life. And I hope that I have been able to explain to you why I so passionately think that property is just a long-term investment, and so many other investment cycles, you're moving things in and out. We're doing the same thing at the moment. We've put money into ISAs every year. You've got to go back and you've got to move your ISAs around. Now, don't get me wrong. You're still going to be monitoring your properties, but you're not buy this house, take all your money out of that house, put your money in the next house, take all your money back out, put it in another house, like you do with savings accounts. You're constantly moving you around to get a best rate. There's a bigger picture here when you invest in property, which I really believe is unlike any other investment class. So thank you very much for listening, and I will speak to you next week. So I hope you found that useful. It's maybe a little complex to conceive at first, especially when I go into using metaphors if you're not with me. But this idea that it's not about getting out the starting blocks as quick as you possibly can and running as fast as you can and then tripping up. It's about recognizing that property investment, particularly if you put that strategy in place first, is a long-term business that you are creating. And it needs to be long-term so that you can spread out all of those initial setup costs and make sense of them. It's so that you can ride the ebbs and flows of property prices while still gaining from the rent. And no matter what the government does, you're going to be in a good position because you've got this steady long-term business that's going through. Yes, you'll add the occasional new properties to it. And eventually, as I'll talk about next week or the week after, you're going to start looking at how you can consolidate that portfolio so that it eventually becomes even higher cash generating. But it takes time. I still think property is sexy. I still think it's got something about it. I wouldn't have been doing it for 20 years if I didn't. But it's not the quick win that everybody makes it out to be. It's not the quick win that people who are trying to teach you trading or whatever else are saying that their version of investing is. It's slow and steady, and this is what is going to create a wealthy life for you. So if you've enjoyed this episode, please subscribe if you haven't already. It's so important to get the subscriptions. It helps me appear in the charts and helps you make sure that you don't miss any episodes. Make sure that you download and please leave a review. If you can leave a review both on Spotify and Apple, even if one of those is your preferred listening space, I would be very grateful. And of course, as you know, we are joining or launching the Wealthy Life community. So make sure that you follow the links at the bottom of this and join the wait list to become part of the community, where you will get access to more resources, more knowledge. Everything that I can share with you will now be in the community. Very best wishes, and I'll speak to you next week.